Thanks everyone for tuning in. I'm Casey Lau from kclau.com. So glad to see you all. Welcome to this online training. This webinar is an educational initiative brought to you by Bursa Malaysia Derivatives Berhad. During this 90-minute session, we will have the first 60 minutes of in-depth training and the remaining 30 minutes for questions and answers. So there will be a Q&A session. Get your question ready and you can type it anytime in the Q&A box. You do it in the Q&A box. It is my honor to have Mr. Warren Mark, the founder and managing director of TED Wealth PLT. He has vast experience in trading, investing, risk management, and frequent training in stocks, structured products, money market, and fixed income securities, forex, swaps, forwards, futures, option, and even cryptocurrencies. So when you come to training on this field, he is the #1 guy we go to now. So Warren, as a CFP, he's a certified financial planner. Today we are going to cover financial planning and hedging, your money and futures. So welcome, Warren.
Thank you, Casey. Hello, everyone. A very good afternoon for those who are from this region. If you are in Malaysia, Singapore, and nearby, definitely now I think you should have taken your lunch and maybe still taking a lunch. Okay, today we are going to talk about financial planning and hedging, your money and futures. I hope most of you, if not all of you, have attended the trade webinar conducted by my good friend Chong Ting Sing for the last 2 months. I think she conducted in 3 topics, English and also Mandarin. There's been a total of 6 sessions. I will be doing the same thing. Today will be my first session in English. Next week will be the same topic, but will be in Mandarin. And subsequently, I will be conducting another 2 more topics in English and also followed by a Mandarin session after each English session. So I will be conducting a total of 6. If you have already attended some futures and option classes, I believe you have some good understandings, especially for those who conducted Chong Ting Ting 6 sessions or 3 or 6 sessions in the last 2 months. I believe you have a very, very good understanding what future contract can help you in terms of trading, hedging, and arbitraging. And for the next 3 sessions, we will be going to impart more knowledge to you in terms of how best you can use derivative, especially futures options, to your advantage as a trader and also as an investor. Okay, let's continue. Disclaimer, this presentation is provided for academic discussion and information purposes only. The presenter, that's been me, Warren, in case you don't know my name, and the organizer do not make any warranty, express or imply, or assume any responsibility for the accuracy and completeness of the contents of these presentations. Please seek advice from the investment advisor before you make any trading and investing decision. Okay, let's continue. Yeah, just now, Casey briefly talked about my background for those of you meet up with me for the first time. Just a very quick intro. I'm the founder and managing director of TED Wealth PLC. From here, you know, TED Wealth means transform equity and derivative into wealth. Yeah. I have 25 years of working experience in the capital markets, including 9 years as a treasury dealer in 2 banks, 1 local and 1 foreign. And subsequently, I joined Bursa Malaysia group companies, work in technically 3 different companies in group of Bursa Malaysia. And I was in business and regulation. Derivative is in the product development and risk management. Yeah. So you see, I have experience in almost all kind of product traded in Malaysia, OTC or exchange traded. Yeah. Okay, let's move on. So today our topic of discussion is, first session, we will talk about money management in future trading. Yeah. This is different from the money management that you have come across. Yeah. Basically, normally when you talk about trading in money management, most people will relate it to how you manage your position in terms of lot size, in terms of margin, in terms of capital utilization, in terms of also what should be your cut loss based on the capital you have. But today we are talking about money management in another aspect. It's more like or more related to personal financial planning, how you can use futures contract to maximize the returns in your overall portfolio in your cash market positions. Session 2, we talk about portfolio and risk management with hedging strategy. Yeah. Okay, let's move on. Money management in future trading. First strategy that I'm going to share with you is cash extraction strategy. How we can make use of index futures contract to incorporate into our cash portfolio so that we can optimize or maximize our returns on our capitals, returns on our investment. So cash extraction, what is cash extraction all about? Basically, if you invest 100% cash and invest in all form of cash instruments like bond, like equities, and even property and anything cash market, then maybe because of the few constraints that you have, including maybe your small capital as a retail investor, then you see, is there any way that I can make use of others non-plain vanilla instruments to increase or maximize the amount of capital I have so that I can achieve above normal returns in terms of based on the cash that I have? That means if another person have 10,000, I have 10,000, maybe both of us only have the return on 10,000 like 10%. Can I make use of derivative to increase my return on my investment despite the fact that I still maintain 10,000 cash? There's no additional in terms of the capital that I can invest, but is there any way? Now I'm going to share with you how we can make use of this index future to achieve your dream. That means, yes, understand you have a constraint of your capitals, but now let us make use of some of the derivative in the market, especially futures and options, to increase the possible returns on investment with your constant capital of, for example, 10,000. So basically, these are the steps. Yeah, if you have a constant capitals for investment, now with the cash extraction strategy, what you can do is you can actually sell part or all of your shareholding to realize your profits and to cash out. Yeah, so you can decide whether you want to sell 100% of your cash holding in terms of the cash investment, like stock, for example. To make it more simple, maybe you say this portfolio only consists of stock. Yeah. So what we can do is either we sell all or we sell part of our shareholding in our investment portfolio to cash out our capitals and as well as to lock in our profit. This is step 1. Yeah. And yeah, please highlight if you have any questions so that Cassie will pose the question before we move on, because for the next 30-40 slides, we will have a lot of calculation, especially if you don't have any background in futures or investment. You may find it a bit challenging. So please stop me so that I can explain further to make you understand. Yeah. Okay. So after you sell all or part of the shareholding, you make use of a small part of the money realized. For example, if you only sell 20%, then you just take this 20% and buy a small sum of the 20%. Actually, you don't need to use up the entire 20%. Yeah, most likely you will use only a part of the 20% that you realize to buy futures or call option contract to maintain a similar exposure to share that you already sold. Meaning to say that initially, for example, after I will show you in a step-by-step example, initially you have a cash holding of certain amount. Now with the cash extraction strategy, you sell part of it. After you realize part of it into cash, then you use a certain part of this realized cash balance to buy some index future or call option. Why do we buy index future and call option? Of course, the reason we buy index future, this one is with the assumption that you are holding a portfolio that is index linked. That means you are a value investor and quite risk averse and also prudent. You say, I am very worried about the risk elements in the stock market. And based on my personal risk profile, in case you know what is a risk profile, I am quite a conservative one. I don't mind investing in stock market, but I try not to take too much risk. Then basically what you do is you will buy or invest only in stock that is listed in, for example, blue chip as a part of the 30 component stock. Yeah, because technically those blue chip which are part of the 30 component stock of the KLCI index, they have the most support from the community, from the fund management, and technically least in terms of the market risk. Yeah, so you buy. But now since you use the cash extraction strategy, you sell some, and with some of the money that you realize, you buy the index future. Because index future will allow you to replicate the risk and reward profile of the share that you just sold. Yeah, because after you sell, you still want to maintain the similar risk and reward profile based on the stock listed in the KLCI component list. That is a reason why you buy index future like KLCI index futures in Bursa Malaysia. What about the call option? For those of you already attended call option, you understand this. But just in case for those of you first time heard of this call option is something like an insurance. It's allow the buyer, that means you buy the call options and enjoy the upside potential of whatever underlying in the call option. So for this call option, we talk about OKLI. That is the call option listed and launched by Bursa Malaysia Derivatives. Don't worry, I just explained in this context, but eventually I will show you a lot of examples for you to understand further. So now we have the information on the background of this index future and call options. Yeah, and the main thing is we want to maintain a similar exposure in terms of risk and reward on the share you just sold. Yeah, part of it. For example, we sell 20%. We don't want to sell all. Let us try with 20% first. Yeah. So, like what I say, after you sell 20%, for example, you have 100,000 portfolio. You sell 20%, that means you cash out 20,000. But technically, if you have a very good index future contract that gives you a lot of leverage, you may not need to use up the entire 20,000 that you just realized from your cash holding to buy derivative. Yes, now we know that from my initial 100,000 cash instrument holding or share, we sold 20%. That means I have 20,000 cash. But you may not need to use up the entire 20,000. For example, you just use, in my example, you use less than 10,000. So you use the proceeds from the sales of share after paying the initial margin for future and option. And I will tell you what is this initial margin for future and options to invest in other form of asset to earn additional income. So now you see, initially we have 100,000, we sold 20,000, we have cash of 20,000 plus 80,000 still investing in share. From this 20,000, for example, I use 8,000 to buy future contract. That means I still have 12,000 in cash. Then for this 12,000, you can invest in other form of asset to earn additional income. You can either invest in bond, invest in REITs, invest in whatever you want. If you think that, yes, 80,000 for share is good enough, 8,000 for derivative is good enough, then I can make use of this 12,000 cash to invest in other things so that I can continue to enjoy additional incomes. Yeah. So now you have three components: 80,000 in cash, 8,000 in derivative, and 12,000 in other form of investment. Because if you do that, you can continue to enjoy any upside potential of share. Remember, you still have 80,000 share. And with the index future, in the next few slides, I will show you. You already show the 20,000 share and realize into cash. How do you make use of index futures to replicate the risk and reward exposure of the 20,000 stock that you just sold? Yeah, of course, plus the additional investment income derived from item 3 above. I just mentioned, yeah, the item 3 above. Let's move on. Okay. So now you know cash extraction. Example. Okay. In my example, I use 84,000. After you know why I use 84,000, because I don't want to complicate the whole thing. If I put 100,000, you have a balance of 16,000, you will confuse. Assume you have 84,000 cash and you want to build a portfolio of FBM KLCI component stock. Yeah. Like I say, you like to invest in stock, but you have a certain risk profile that you say, yes, I want to invest in stock, but I just want to invest in KLCI component stock. Yeah. So you have 84,000. And you have two options. Either you use cash, that's means 100% of your investment in cash, or you can use FKLI contract. FKLI contract is a index future contract built on KLCI. Yeah. With these two options, you can achieve the same or similar risk and return exposure. Let us do some calculation and you will understand. Option 1, you buy 30 component stock based on the respective weightage. Yeah. And in the FBM KLCI, what do you mean by respective weightage? Our KLCI component, the KLCI index, is a market capitalization weighted. That means, for example, Maybank is the largest one. If the major, based on Maybank market capitalization, which is, for example, 100 million. Now Maybank is about 110 or billion. Let's make it very simple, 100 million. And the total market capitalization of the 30 stock is 1,000 million, for example, 1 billion. So Maybank will have 10% weightage in the entire 30 component stock, total market capitalization. So in your option, you will use 10% of your 84,000, that's means 8,400 to buy Maybank. And for the rest of the 29 stock, you calculate their respective weightage in the 30 stock, and you use the respective amount of money based on the respective weightage of individual component stock to invest in each stock. So you're fine. Yeah, you replicate the 30 component stock. And after you buy all 30 based on their respective weight, you spend 84,000 to build this portfolio. That means your portfolio is actually 100% KLCI component portfolio. That means technically the movement of KLCI is 100% same as the movement of your component. Yeah. So option 2, you can spend 4,000 initial margins to buy one contract to gain the same risk and reward exposure to the portfolio you just bought with option 1. Why 4,000? Because currently one contract of FKLI, which is the index future contract with the underlying of KLCI, require you to put in 4,000 of initial margin to the exchange. Of course, you pay it via the broker. You pay to the broker will deposit the initial margin with Bursa Malaysia Derivatives Clearinghouse. Yeah, that means instead of using 84,000, technically your capital outlay is only 4,000 now. Yeah, that is the initial margin you have to put in order to buy one contract of KLCI future, which is FKLI. Yeah. Now with the assets of 80,000, you can either buy more stock or invest in other assets or enjoy additional return or incomes. Like I mentioned just now in the old example, you have 100,000, you sold 20,000, but you only use part of it to buy future contract. The rest you can invest in bond, you can invest in property, you can invest in REITs, you can invest in any structured product. Yeah, based on your investment objective as well as based on your risk profile. Very, very important. You have to invest of a trade based on your risk profile. So now you know, instead of 84,000, I don't buy any stock initially. I buy 4,000. I pay 4,000 initial margin because 4,000 initial margin allowed me to buy one contract of FKLI. And one contract FKLI technically can replicate the risk and return profile of the entire portfolio of KLCI component stock with the capital of 84,000. Let us do more calculation and I show you the example so that you'll be very clear after that. Yeah. So your option 2, your cash achieve a leverage of effect of 21 times with the future contract. What do you mean by leverage effect? Meaning to say that if you pay 84,000 to buy all the 30 component stock, now you only fork out 4,000, but you enjoy the same risk and return profile of your portfolio. And because of 4,000 is only, if you use 84,000 divided by 4,000, you can see the difference is 21 times. The leverage is 21 times. This means every single movement of the futures will lead you to 21 times of the effect in terms of risk and reward in the cash market. This is called the leverage. So I put all this into a table for you to understand more clearly. Yeah. You can see from here that we have two columns. One is for index stock and one is FKLI futures. Like I mentioned just now, if you want to buy 30 stock in the cash market, you have to fork out 84,000. But if you buy one contract, which give you the notional value of 84,000, how do we derive the notional value of 84,000? Yeah. One index point in the FKLI is equivalent to 50 ringgit. For example, our current KLCI or FKLI is at 1,680. times 50, you know, we have 84,000. In the technical term, in the derivative market, we don't call it market value or nominal value. We call it notional value. Yeah. In the cash market, nominal or market value is 84,000. But now we know that with one future contract, we can achieve the equivalent notional value of 84,000. So now you see 100% match, 84 against 84. Like I said many times, capital outlay in the cash market is 84,000. But in this FKLI, you only have to pay 4,000 initial margins. Leverage, of course, no in the cash market. In FKLI is 21 times, as we calculated just now. One thing is, if you buy cash in the stock market, you will enjoy any dividends declared by any of the 30 component stock. In the future market, you don't enjoy this. That means no dividend payout to you. And of course, in terms of market direction, when you buy stock, technically you can long or short. Shorting, you can use intraday IDSS or sell via RSS SDL. Restricted short selling with the stock borrowing and lending mechanism. In future, very easy. Long or short. Long, that means you buy the futures. Short, that means you sell the futures. And for stock, technically, there's no expiration if you buy and hold. You can hold until either you die or the company die. That means when the company not die in the sense of really bankrupt, maybe the company could be delisted due to privatization. Of course, some actually naturally bankrupt, so they're delisted. Yeah. And of course, if you short your stock in the market by using IDSS, you have to cover it before the end of the same day. Yeah. And of course, FKLI future, the contract expired on the final business day of the month. Depends on which contract month you buy the futures or short the futures. Let's move on. Okay, financial planning, portfolio optimization. This is what I meant just now. How do you make use of derivative contract? In our example is future, to maximize or optimize the returns of your portfolio. Yeah. So when a part of your portfolio balance is not invested, but in cash or cash equivalent security, this is referred to as cash drag. I don't know how many of you heard of this terminology, cash drag. If you invest in maybe exchange traded funds, or you invest in mutual funds, you would have heard of this cash drag. Cash drag, that means the amount of money in the form of cash or cash equivalent that is not invested in the security that you're supposed to be holding. That means if you're holding a high growth fund in a unit trust, basically most of the investment in this so-called high growth fund should be invested into those high growth stocks. But because of the investment policy, because of the investment strategy, technically hardly any fund invest 100% of their cash into the so-called balance fund, high growth fund, index linked fund. That means there's a small part, a component from the entire portfolio is actually in the form of cash or cash equivalent. Yeah. So this is called cash drag. Let us see what is cash drag and what is the problem with cash drag. Because cash earn a below market returns and dilutes the overall portfolio returns. High growth fund, you may expect at least 7 to 8% return on investment. But the cash component in this fund actually earn you, like Malaysia, maybe earn you 3%, 3.5%. If you put in a cash account or saving accounts, maybe earn you 1 to 2%. That means eventually when you calculate the overall portfolio returns, this part of the cash, the return on investment in this part of the cash will actually dilute. That means will bring down the average return of investment in the entire portfolio. For example, if you have 90% invest in high growth stock in this high growth fund, but 10% in cash. If this 90% give you 10%, and this 10% of the cash give you only 3%, don't have to calculate, you know that at the end of the year, you will not get a 9% return on this high growth fund. You will get slightly below 9, maybe 8.5, 8.3, 8.2. Yeah, I will show you the example and calculation. So the cash rate will bring down the overall portfolio returns on investment. Yeah. So holding cash may suffer from a real negative return over time due to inflation effect. Not only this, if the return on cash for this part of cash in the entire portfolio, if the return on cash is actually lower than the inflation rate that you are facing, or rather suffering, then technically you are losing money on a daily basis because you are enjoying a real negative returns over time. For example, your cash only earn you 3%, and the inflation for the year is 3.5%, for example. So technically, on average, every single day, you are losing 0.5% due to the so-called negative real interest returns. You are losing the purchasing power. You are losing value of money. Yeah, that means you cannot buy as much. Compare end of the year to the first day of the year because you are losing purchasing power on every ringgit that you're holding due to the inflation rate is higher than the cash return. Yeah. So now you have a stock investment portfolio of 900,000. This is the examples. And 80% of the portfolio is invested in equity and the balance of 20% is in cash. Yeah. I just realized that I keep looking at the video. Technically, my camera is here. Okay, now I face you. 80% of the portfolio is invested in equity and the balance of 20% is in cash. Now you see, 20% in cash. Assuming last year, 2017, your KLCI gained 10% and the saving rate for your cash is 3%. That means you put 20% of cash from the 900,000 portfolio in a saving account and give you 3% return on your savings. And KLCI, you keep it in the portfolio for last whole year and generate 10% return on your portfolio. So what is the eventual average or total return of investment in your portfolio? So the return on your total portfolio is 8.6%, which is 140 basis points below the market returns. You see, 80% of your portfolio gain 10% and 20% of your portfolio gain 3%. So eventually your average return for the entire portfolio is 8.6%. So how do you bring the 8.6% back to 10% or even higher? One solution is to buy along index futures. So first step first, we have to calculate the hedge ratio. In terms of portfolio, hedge ratio means that your portfolio size divided by the future size, the value of the futures, times the beta. So for understanding purpose, hedge ratio is a comparison of the value of the future contract purchase or sold to the value of the cash underlying being hedged. So the relationship between the future contract and also your cash underlyings. And why you need a beta? Beta is a measure of the volatility of the security portfolio in comparison to the entire market or benchmark. You need to know the beta because of you need to ensure the future contract or the derivative contract that you buy or sell to hedge against your cash portfolio can replicate the volatility, the price movement in the cash market. Yeah. Because future price and the portfolio can have different in terms of the movement called the basis and also volatility. And I will show you in the subsequent slide. Now we calculate hedge ratio. So assume that our portfolio beta is 1. 1 means to say that actually this one is not an assumption, this is real. Because when we talk about beta 1, that's mean the volatility of your portfolio and the volatility of the index, the market, overall volatility is the same, 1. Why this is 1? Because in the market, we use KLCI components as the benchmark. So that is the beta 1. Since we are buying a portfolio with the underlying, which is the KLCI component stock, these two things actually is identical. If you want to hedge non-component stock, which is out of the 30, but you use FKLI, then the beta will not be the same. Yeah, this will not be the same. So now the beta we know is 1. And assume you want to use November FKLI contract for your hedging purpose. And now the FKLI is trading at 1750. Now you know, So this is a hedge ratio formula. Okay, just now we know that we have a 900,000 portfolio and 20% is in cash. So we want to hedge not entire portfolio, but we want to do portfolio optimization on the 20%, which is in the form of cash, by using the futures. And the future value or the future size is 1750. This is the FKLI index level now. And because each index equivalent to 50 ringgits. So 1750 times 50 ringgits. Now we know that the hedge ratio, that means in layman term is what is the number of contract we need to buy in order to do this portfolio optimization. So based on the hedge ratio, you should buy 2 FKLI future contract so that your portfolio returns will track the overall market returns closely. When we talk about this overall market returns, we are talking about the 30 component stock. Yeah. So now, from here, you see this example. Actually, because after you buy these 2 contracts, you will replicate the risk and return profile of the entire portfolio of 900,000 as if everything is in stock. And don't forget, after you buy these 2, you still have a lot of money in cash, and this cash can be used to invest in bond, REITs, property, and other form of physical or exchange traded investment. This will further add to your returns. Initially, 900,000, everything is derived from only the stock that you're holding. But now, with this portfolio optimization strategy, actually you free up 20% of cash, and this 20% of cash, a small part of it, used to pay the initial deposit for the initial margin, and the rest you still can invest in further investment to enhance your returns. So in this portfolio already optimized, even though you maintain the same risk and return profile of the 900,000 cash holding. Yeah, of course, when you invest the rest in, like for example, bond, property, and risk, you have another level or another degree of risk profile. Yeah, that is beyond the scope of today's. Yeah, but this example show you that by using only 2 contracts of FKLI, actually you can mimic, you can replicate the entire 20% cash that you did not invest in the stock in the first place. So we go for the strategy number 2, portfolio and risk management with hedging strategy. Yeah. For those who attended Chong Ting Ting session in the past, you know that she talked about this hedger, speculator, and arbitrageurs. Hedger technically are those who employ hedging strategy to hedge against the downside risk of the portfolio. It's called hedging. Speculator, very easy, you just buy and sell, long or short. Arbitrager, that means you make use of derivative to make money from the risk-free arbitrage. Yeah. Okay, let's talk about hedging. What is hedging? What is a hedge? A hedge is a risk management measure to remove or at least mitigate any substantial losses suffered by a retail investor, fund manager, or organization. So if you invest in the stock market, for example, definitely you will feel downside risk when you want to enjoy all kind of upside potential. And a hedge is a strategy for you to remove or at least reduce or mitigate any substantial losses. So technically, hedging means transfer of risk from one party, the asset holder, you or me, to another person. Most likely, the other person who assume our risk is a speculator. They just either speculate or do trading based on their assessment of the market direction. So they assume your risk and you transfer the risk to them to hedging. Yeah. And the net result of the hedge to you, of course, the most ideal scenario is you want to achieve a perfect hedge. That means when you do hedging, on one hand, you will have P&L, profit or loss, of the cash position that you are holding. On the other hand, which is basically is an opposite direction, you will suffer losses in your hedge positions. Yeah. And what you want to achieve is the profit and loss in the cash instrument plus the profit or loss in the hedge position, when they add together, is 0. You just want 0. Yeah, 0. Yeah, now, okay? Yeah. Of course, you will ask me, yeah, now I have some understanding of hedge, but why hedge? How come I just don't hold it or sell? If I think the market is going to go down, why bother to hedge? I just sell. That means if I sell, I will not suffer any potential losses. Maybe this is a better idea because it's easy. I just sell. I don't have to calculate hedge ratio. I don't have to do futures, option, and all others. Why bother to hedge? Now you see the reason why people want to hedge. Why hedge fund want to hedge? Yeah. Maybe you are using the share in your portfolio and pledge with a bank or a financial institution and what? Cash out. You want cash. Maybe you constrained by fund investment policy as a fund manager. All funds are governed by fund investment policy. If this is a high growth fund, index-linked funds. Maybe so not say maybe. Technically, from what I understand is you can't sell everything into zero. That's mean based on the fund investment policy, no matter the market crash, the market, whatever happens, you have to hold minimum 50% in equity. Meaning to say that you can only sell half of the entire portfolio, no matter how bad is the market. So since you cannot sell, what do? Of course, you do hedging. Yeah, this is the second reason. The third reason is more economic in terms of overall fee and time and efforts. Because if you keep on selling, buying, buying, this will require you to do a lot of analysis, a lot of portfolio rebalancing, swapping, and require a lot of times. Of course, when you buy, sell, every single time you have to pay commission, stamp duty, and trading and carrying fee. Yeah, last time you even have to pay GST. You see what I mean? In order to avoid all these additional costs to the minimum, why minimum? Because when you do hedging, you also have to pay some kind of trading carrying fee and maybe even stamp duty and whatnot. But because you're using hedge instrument, the amount of cost of the fee paid is much lower. So you optimize by paying less. Yeah. Good dividend yield. Yes, you are holding this good dividend yield stock, and you either one thing you would like to enjoy the good dividends, or second thing, actually this is part of your portfolio is the high yield portfolio. So you still cannot sell. So if you cannot sell, what do? You do hedging. Yeah, and of course, if you are a major shareholder, either controlling stake or not controlling stake, you just want to keep the shareholding percentage. You don't want to sell your stock. When you sell your stock, either you lose control of the company or maybe will cause other problems. So you say, no, I am not going to sell. But I know that the market is maybe sideways or have a chance to go down. What can I do? Do hedging. Yeah. And of course, what can be used to hedge? You can have many types of financial instruments used to hedge. Forward, swap, exchange traded fund, option, future, and other OTC and exchange traded products. But today, we focus on using future to hedge. And before we continue, of course, when you have the pro, you definitely have the cons. Yeah. Hedging, you will face challenges with hedging. Yeah, let us address some challenges first before we proceed with hedging calculation and example. You can't find a suitable hedging instrument. Yes, just like last time before BMT rolled out FM70, you can't technically have a perfect hedge of your non-KLCI component stock. What we can do is we can use cross hedge. Yeah, what do you mean by cross hedge? For example, if you have a portfolio of silver, Bursa Malaysia don't have silver futures. Then you make use of the gold future listed in Bursa Malaysia Derivatives and hedge it. So this is called cross hedge. Yeah. What about liquidity issue? You say, yeah, I want to hedge 4 months, 1 year. But the farmer, the further maturity contract don't have much liquidity. That means don't have many bid and offer. But your position is quite big. You can't do this. So you are facing a so-called liquidity issue. Then you can use stack hedge. Don't worry, I'm going to give you an example later. Another issue is hedge period issue. You say, similarly, you want a long tenor and further months also don't have enough contract for you to buy and sell. And what can you do? Yeah, this is more on the period. The second one is more on further months don't have the liquidity. And this one is, you talk about now to a long period. You say you want to hedge a long period because your exposure is long period. So in order for you to hedge a long period, you want to hedge based on the exposure. And if you can do a perfect hedge, that means if your exposure is 1 year, you want to do 1 year hedge rather than, yeah, I know the first contract man have the highest liquidity, but I want to cover my risk exposure in terms of the period. So I use strip hedge. Yeah. After you see what is strip. And another problem is when you're dealing the hedge, you may be facing basis risk. What is a basis risk? That means, just like the cross hedge, you cannot find a perfect hedge. Yeah. Of course, basis risk not only caused by cross hedge, you can be caused by stack hedge and strip hedge. Yeah. Let us look at all this. So what is the basis risk? Basis is a difference between the spot, that means the cash market price, and the hedge instrument. So basically hedge instrument, we are using futures. So the spot price is, we put S, and the future we put F, of a similar or same underlying. Second one is a price basis risk. Basis is just a general. This one specifically talk about price because there are many types. Can be quantity basis, quality basis, period basis. This one we talk about price. So it's between different between the spot price and the future price when they do not move in tandem during the hedge ratio period. Don't worry, I have a very nicely done chart that is drawn by me and show you later on. On the hedge initiation day, that means first day when you initiated the hedge position, basis is known. That means first day, I have the cash instrument, I have the hedge position. First day, I know exactly what is the difference between S and F. But when the hedge is lifted, that means at the end or the maturity of the hedge period, I may not know how many points is the basis difference. Yeah, when the hedge is not perfect. Yeah, let us look at the diagram. You see here, day one, you know exactly what is the level here minus the level. You know this is your basis. But when the cash price move, future price move, which is not in tandem, that means they don't. When cash price move 1%, future may not move 1%, can be higher than 1, lower than 1. So you can see the two curve is slightly different. So here you have an unknown basis risk, yeah, due to the unperfect hedge. If these two are identical in terms of the underlying, in terms of the maturity, when these two actually meet at the same point, you don't have unknown basis risk at the end of the hedge. Yeah, this is called the perfect hedge at the end of the period. So now we use FKLI instruments to show you the example. First thing first, of course you ask, there are so many contract months, so many maturity months, which one should I use? First thing is, like I say, because our portfolio is KLCI component stock. Now we know that we can either use FKLI, which is a KLCI future contract, or we can use FM70. And if you don't understand, you may ask, should I use FCPO? Should I use gold futures to hedge against my underlying? No, you have to know it. If you want to hedge against your KLCI components, you use FKLI, okay? Because this one have the same underlying, have the least basis risk, yeah? Second one, What about the liquidity? So I choose of course, technically you should choose the most liquid contract. For example, FKLI is a spot month. Immediate month, November is the most liquid. For FCPO, the third contract month is the most liquid. So for different underlying, for different instrument, you have to find out, and you cannot assume the current month contract is the most liquid one. No such thing. You have to find out, yeah. And of course, contract month should be the same as the date of the hedge to be lifted or slightly longer. For example, if you want to hedge your portfolio until March 2019, then technically you should buy the March 2019 contract and not buying the November or December. Of course, if you want to hedge against April and May 2019, March 2019 is a bit too short. It's better to hedge a bit longer. So if you have a portfolio, you want to hedge until April or May, you should buy the June 2019 contract. And another one, if you can't find a perfect contract, then you use a contract that have a very close relationship in terms of the price movement, price trend, volatility basis. For example, you use gold future to hedge against silver price. But gold and future have different so-called beta. If gold is 1, silver could be 1.5. That means in the formula itself, you have to put in 1.5, for example. Yeah. Now we settle with which contract to use. Now let's just go into a method. So a firm want to hedge again the price risk faced by the company product delivery obligation for 6 months. Yeah. You can use either the strip futures, strip contract, strip methodology. That means each one with a different contract month. You buy a strip of future contract, and for example, November, December, January, February, March, April, if you have individual contract month. If not, you can buy a stack of future contract. That means only the nearby. Don't worry, confusing. No worry, I already have nicely done graphic for you. Okay. So a strip of future, normally same quantity for each contract month, is also called a calendar strip. It's the simultaneous purchase of sale of future contract in consecutive month. Yeah, all these are consecutive month. Okay, this is one. So you see, for example, your strip hedge start in 2019. What you do is remember, we said the hedge period is 6 months. So you either buy or sell January, February, March, April, May, June. 6 months, monthly basis, because this one have monthly contract. If you don't have monthly contract, you have to buy quarterly, weekly, and any other period, any other interval. And like I say, you use the same size. That means every month you use same number of contract months, which is 100 in this example, because your exposure is 100 per month for the period. Yeah. What happens if you can't use strip hedge methodology? Then you can use stack hedge strategy. A stack strategy talk about one stack of future contract, but also with the most nearby and liquid contract. That means you start with the most nearby and liquid contract. Yeah. Let's look at the example. And when the first contract month expires, the holder will roll over the position to the next contract month. That means in January, when you have the January month expire, you go to February and March, April, May, June. Let me show you example in the diagram. And in every rollover period, the rollover contract will be reduced with a predetermined quantity and formula. Yeah. Remember, just now we have a requirement 106 months. So in aggregate, it's 600 contract in the strip futures, strip hedge. Yeah. So in the stack hedge, you know that just now we have to buy 6 contract month. In aggregate, the notional amount is 600. Now for the stack hedge, first contract month we buy January. That means we only buy 1 contract month every single time. Just now, concurrently, we buy 6 contract month for the strip hedge. For stack hedge, we only buy 1 contract month every single time until the first contract month, the existing contract month expired. Then we roll over to the next contract month. Again, we only buy 1 contract month. So assume we start with January. Remember, we just now said the total aggregate notional amount is 600. So we buy 600. At the end of January, we roll over to February, we reduce 100. Every single month, you reduce 100 until the June contract. Remember, strip hedge, in January, technically, you have 6-month exposure. Technically, you have aggregate 600 contract, 600, if this is 1,000, 600,000 exposure. Yeah, but January, you have 600. After January, you have only 500. That's been 1 out of 6 already expired. You reduce your exposure by the same quantum every single month because you already reduce your risk exposure by 1 month. Yeah, January reduce. Then you go to February. When February contract expired, technically you reduce 1/3 of the exposure because 2 contract months expired, you still have 4 months to go. 2 divided by 6, you reduce exposure by 1/3. Yeah, this is called stack hedge. So you can compare liquidity. If it's good, you use the nearest one because of the far month is not liquid. Stack hedge actually more costly because you do a lot of rollover. Strip hedge, you do it once. That means you buy 6 contracts. Remember stack hedge, first time you buy 6, second month you buy 5, third you buy 4, 3, 2, 1. So in total you buy 21 contract. Strip you only buy 6. Yeah, more costly. Basis risk is higher because you only, for stack hedge, you only hedge against 1 month. You're open, your risk exposure is open for the 5 months. But strip, immediately you cover all 6 months. Yeah. So in this reason, for this reason, you reduce the exposure by covering all contract month with the strip. Stack, you only cover first contract month. Your another 5 contract month actually is totally exposed. Hedge period, single for stack, multiple period for strip, like we say. Contract size reducing, strip hedge, we put it is the identical for each individual month. And commonly used for what? Stack hedge, we use it for spread trading or single period hedging. For strip, normally you use for interest rate hedging. For example, you want to hedge against interest rate exposure for 3 years, 5 years, and for long-term obligations. Yeah. So portfolio management with hedging. Let's look at some example. So first of all, when you are long, that means you are holding cash, you should short in the future position. That means in cash, you hope the price go up, but in future, you want to hope that the price go down so that you can cover your risk exposure. That means you have to buy opposite direction. You cannot buy cash and long futures. You have to buy cash, short future, or if you can short cash, you long future. Opposite, yeah. Secondly is you calculate what is the number of futures in order for you to neutralize the likely changes in the portfolio value. Just like when we talk about the portfolio optimization strategy, is the same thing. In our example, the 2 contracts actually replicate the exposure in the 20% of the cash holding. Yeah. So now we calculate. Yeah. So for example, you use back the same example. You have 900,000 portfolio, beta is 1. because the portfolio is well diversified, you want to short FKLI to hedge against the portfolio. Currently, FKLI is traded at 1750 index level. Now we want to find out how many contracts should be short in order to hedge against our portfolio holding. Okay. So this is the same formula, hedge ratio, but the difference is just now we have 20% in cash. This one we say we want to hedge the entire portfolio. So 100% of the cash is in stock, meaning to say that the entire 900 have been invested in stock. And the future size is, remember we talk about now trading at 1750 and each index is 50 ringgit. We also assume the beta is 1. Just now when I talk about stock, gold and silver, if the beta is 1.5, you have to put 1.5 into this. So the answer is 10.28. Yeah. So what do you mean by 10.28? So 10.28, which is 10.3. But the problem is, yeah, you calculated 10.3, meaning to say that you are supposed to buy 10.3 contract. However, since the minimum size of FKLI contract is 1, you can only short either 10 or 11. So it depends on your risk profile. If you think 10 is enough, then 10. If you think, no, I want to cover more, then will be 11. Yeah. So you can see when the cash market falls. So this is the hedge example. So now you know that the portfolio holding suffer losses because stock markets drop, Bursa Malaysia drop. Yeah. But you will gain in the future contract because the future contract is on the opposite direction. Cash market drop, cash holding lose money. But since you short the future, meaning to say that when the cash market drop, future market drop, you will make money from the short positions in the future contracts. Yeah. Let us use the previous example with the portfolio size of 900. Yeah. So assume now the cash market is 1760, your FKLI is 1750. From here, you'll see that a lower FKLI value indicates a discount reflection of bearish sentiment. Wow, perfect. Because you based on your assessment, your real market is going to drop. And actually from the FKLI, you can see that the future price of the market actually is lower. Yeah, that means it's bearish. So over the next 1 month, for example, you hedge it for 1 month. Actually, yes, you are so right. FKLI or FBM KLCI dropped to 1680, lower. Yeah. So assume you close out your future portion when the FBM KLCI is at 1680. Yeah, you say, okay, month end, my future contract, November 2018, also expired. I just want to close it on the same day. That's the last trading day, business day of the month. Yeah. So you close at 1680. So for the 900,000 portfolio, when FBN KLCI dropped from 1760 to 1760 to 1680. So the calculation is what is the eventual result minus the original level when you buy the portfolio, when you construct the portfolio, and then divide by the original. So you know that there is a drop of 4.55% value in your cash position. Then now you use this drop of 4.55 beta of 1 times 900. You know that in the cash position, you suffer a loss of 40,950. Because you don't sell, you're still holding it, the price drop from the portfolio drop from 1760 to 1680, you actually suffer a cash loss of mark to market 40,950. Market value of a cash portfolio drop. But luckily, you have done your hedging. You have a short contract of FKLI futures, or rather 10 or 11 contracts. So when you short at 1750 and drop to 1680 when you close it, you do 11 contract. So when you calculate the P&L, actually you make 38,500. Wow, you make money. But this is not trading gain. This is hedging gain. So the net hedging result is you lost 40,950 in the cash market. You gain 38,500 in the future market. Net, you actually still suffer 2450 losses. This is the result of not a perfect hedge. Yeah, not a perfect hedge. Yeah. Why? Because usually we cannot achieve a perfect hedge. Remember, just now when we are supposed to hedge 10.28 contract, we can't. So end up we hedge, of course, 11 contract. And also, initially when we hedge, the market, cash market is 1760, but the future already 1750. That means what? You already suffer a 10 basis point of the imperfect hedge. Yeah. So one thing is, like I say, normally you're not able to hedge 10 point something because future contracts are mostly coded in integral. That means whole number, either 10 or 11. You cannot hedge 10.28 contracts. And also, like I say, the 1760 against the 1750, that is a 10 basis point difference already. Yeah. And also, sometimes stock portfolio unlikely to behave exactly as the historical beta. Of course, in our example, it's a perfect hedge. Yeah. Because we actually buy everything based on the weightage of the KLCI component. If, for example, we only buy 10 component stock out of the 30, and then we use a FKLI to hedge. And after the calculation, you say that the beta is 1.2. This is based on historical movement, but end of the day, maybe the beta eventually is 1.3. So you still have a mismatch. That's why this is one of the reasons why you cannot achieve a perfect hedge. Yeah. And of course, if you use silver, gold futures to hedge against your gold futures to hedge against your silver futures, this is a cost hedge. Definitely, immediately you know that you are not having a perfect hedge. Yeah. So very quickly, we have done with the future side in terms of the example. Now I want to give you the next two slides to talk a little bit about OKLI. So actually OKLI, the settlement price is not FBM KLCI. The OKLI, the settlement price is based on the future. That means it's FKLI. And you are very lucky because of what? All of you are actually looking at the person who launched this product. Yes, in 2010, I was the head of financial derivative in Bursa Malaysia Derivatives, and I am the one, the head of departments, to roll out this option on futures. Yes. So hi, okay. So we use option to hedge against downside risk. Now future price, November contract is 1720. And the strategy, instead of buying one contract future, now you say, let me buy option. Because people say the future move both sides. Option, because option is like insurance. After you buy option, you don't have to worry about downside risk because the maximum risk is what? The premium pay. Yeah. So you buy one contract, OKLI, put at the strike price of 1700, November 2018, put at 16 points. Premium 16 points times 50, actually you have to pay 800 ringgit. The break even is 1684. Why 1684? Because you have to factor in your cost of 16 basis points. So the risk is limited to premium pay. Because option contract is actually an insurance contract. Yeah. So you can see, after you buy a put at 1700, when the price goes up, when the price of the market goes up, you lose nothing additional because 16 point, which is equivalent to 800 ringgit, that is the maximum loss you can suffer. You don't suffer any more after you pay insurance premium. You can claim on the insurance. But when the price go down from 1700, actually every single strike price, this is a future strike price level, you're actually making money. When you make money in this part, it's similar to making money in the future, that you want to use this gain to offset the losses that you suffer from cash. So this is another way for you to do hedging in the market if you're holding a cash portfolio. Yeah. So when the cash market value fall, you will suffer losses in the stock portfolio. Yeah. But you will gain in the put option like what we showed you just now. Yeah. Okay, technically, I already finished my slide today. What I'm going to show you for the next few slides is, please continue to join us in our future workshop organized, brought to you by Bursa Malaysia. This is for Mandarin, getting started in future trading and trading plan, 10 November, which is this Saturday. And the next one is 20th and 24th. You can check it out after you will see the, you can check out on this registration. Another one is you have more future and option contracts, option workshop from November to December. You can see you have English, you have Mandarin, you have KL, Ipoh, JP, Penang, different places, different date. So please take a screenshot of this. If not, you can go to Bursa Malaysia website and check out the date. Take a screenshot of this or take a photo of this. If not, take a photo, a screenshot of this QR code. Once you scan this QR code, it will bring you to this registration page, which is handled or managed by my friend Chong Ting Sing with her excellent companies. Yeah, please learn future and option, and this now is the most suitable time for you to do it because of course, you know future leverage, and also if you think in the next few years, maybe the market is going to turn bearish, even with a bubble, bust, crash, whatever you name it. If you want to protect your downside, future and option definitely is a must-learn topic. If you dare or if you want to, it's a must-use contract in Malaysia to do hedging of your cash portfolio. If not, you have to sell all. Of course, just like I tell you, if you sell all, in, out, you cost a lot of time, effort, and money. Hedging could be one of the second alternative that you should consider. Yeah. So 5 key takeaway point. We talk about cash extraction strategy with index futures. We talk about portfolio optimizations. We talk about hedge and basis risk. And we talk about hedging example with FKLI. And also we talk about hedging example with OKLI. So with that, thank you for your time. You can follow me on Facebook or go to my website and email me if you want to continue to know more about trading, hedging, arbitraging, portfolio optimization in the cash and derivative market in Bursa Malaysia. Yeah. Now is a Q&A. I think we still have about 10 minutes for Q&A. Maybe Casey can
Warren,
the Q&A. Yes,
yeah, Warren. Yeah, it's really interesting sharing session that you have gone through with us. We talk about like cash extraction strategy. Many people don't ever think about that, and then also the cash drag, which is a real thing that is drag down your portfolio when you have cash that is not invested. And then you show us the calculation, things like hedging ratio, and then you talk about the different type of hedging you can do, like cross hedge, stack hedge, and strip hedge. Oh, it's really interesting. So let's do some Q&A. So if you have any question, you can type in the Q&A box so that we can monitor your question easily.
Not to worry, I believe to many of even the existing trader in the future market, some of the concept that I bring out like stack, like strip, and all this optimization could be totally new. Yeah, but it's better start now than never. Yeah. So, and from the audience.
Okay, there are some simple questions. They say they have a lot of info to digest. Okay, let's look at the first one. This is from Alan. He's asking how many puts options should we use? Is there a formula for that? So I think you briefly touched on.
It's a similar one. Like for example, this put option and the FKLI is the same. So you just calculate the hedge ratio. Yeah, you calculate the hedge ratio. From there, you can derive how many contract you should use. Yeah. So basically, you have to calculate the hedge ratio by using the formula. You have to first find out what is the beta. Yeah, and all this. Of course, beta is not easy to obtain. Yeah. It's not easy to obtain unless you do your own calculations. Yeah. Otherwise, you have to find out, for example, if you're holding the FKLI component stock, definitely FKLI is the best one for you to use. And that one you can, if your portfolio is well diversified, technically the beta is 1. Yeah. If not, you really have to find out from, I don't know, Bloomberg, Reuters, or even do your own calculation, what should be the beta. But don't worry about beta. You know why? One thing, technically, most of the hedge is not perfect hedge. When you do hedging, you're not talking about, I want to achieve a perfect hedge. You want to try to mitigate big chunk most of the risk, because even you use the same hedge, your beta, whichever calculated, is historical beta. So very unlikely your future beta is identical. That means no matter how much you want to have a perfect hedge, eventually you can't find a perfect hedge. Yeah. So it's okay. So you can either do a bit more or a bit less, because your intention is to hedge against big chunk, most of the risk, and not 100% of the risk. Yeah. So use the same formula, hedge ratio formula, to calculate how many contracts you need to use. Yeah.
Okay, make perfect sense. And this is some simpler questions by Joe. Is will the recording be made available? So I'll answer for you this one. Yes, it will be available on my Facebook page. You can come and check back. My Facebook page is facebook.com/KCLaumoney. You'll see the full recording of this session here. And then Joe says that there are too much info to absorb today. So do you offer any courses that we can attend?
Yes, if any courses offer in future, definitely I will ask Mr. Casey Lau to help me to inform you. Not to worry.
Nice.
I will buy him that direct. Yeah. Okay, Casey.
Yeah, sure. So yeah, if you want to learn more from Warren, maybe you can check out the sessions that is organized by Excellent. Do you teach any of the session there at Excellent?
No, maybe in future we will work together. Yeah, and you can follow me in Facebook and my website, and send me a mail so that I can put you in the mailing list if you want to. Yeah.
Yeah, nice. I know that you do a lot of physical seminar, but is it mostly for those in the industry, like the professional reminders?
Yes, I do a lot of in-house and public CPE continuing professional education to license holders. When a market professional, they get license from maybe from SCCA, fund management, Security Commission, Bank Negara, that can attend my course. But I also have Security Commissions and others organization to do roadshow. So you can always check out broker roadshow, my website, Bursa Malaysia website, SC website, to know about all this. It's for the public. Yeah, it's for the public. And
nice.
actually, yeah, actually I will announce in the next one for those of you who understand Mandarin, you can check out the Nanyang Xiangbao. Every Thursday, I will write an article in Nanyang Xiangbao actually. Every Thursday.
Every Thursday too, so we can check out your article in Nanyang Xiangbao. Is it in the
Actually, can I show the website? Nanyang Xiangbao website.
Yeah, sure. You can.
Let me see how I can
click the share, and then you have to choose desktop. Then you pull up your browser.
Yes. The browser is here.
Have you put?
Can you see?
Okay.
Can you see?
No, not yet, because they're showing up your browser.
Oh,
but
I have to share first.
Yeah, you have to click share, and then you choose desktop.
New share and okay. Share.
Okay, we are seeing it now.
Yes, this is the website. You can see it, right?
Yes.
Let me see. Okay. So this is the eNanyang. You click eNanyang.my and go for this 主页名家专栏投资把脉 and me. So if you go to 主页, you can read all my past 45 articles and all the futures one. Yeah, all the futures one. Yeah, this is the one. Yeah, this is the one.
Okay,
so,
awesome.
So we go back to this one.
Yeah, no problem. So yeah, I have a question here. Is that when it comes to hedging, right? Most people will think that you will need to have some portfolios, like say 100,000 or at least 84,000 to be compatible with one contract of futures. So like for those who are not investing so much yet, so maybe they're starter, they are just having a few thousand ringgit and thinking of investing. So basically most people will start with, let's say, unit trust, right? So they will slowly have more exposure in investment before they ever think of like futures. So what do you think? Is this the correct way? Like you have a CFP, you are a CFP holder, so you kind of like.
So when your portfolio is less than 84,000, technically you there's no issue for you to use a contract because your exposure is too small for the future contract to hedge. Yeah, unless you have some mini FKLI contract. Yes, maybe in future they will roll out some mini. Of course, the FM70 is a mini size. Yeah, just like in overseas, some of the exchanges they roll out mini contract. Yeah, so maybe if there's a demand, they will have. Then you can alert Malaysia Derivative. We may want to have a mini FKLI future contract. Yeah. Then maybe the size is like normally it's like 20%. That means you can hedge against your future contract less than 20,000 of your cash portfolio. Yeah. Maybe we can. If you have more feedback saying that we want to have a smaller contract, then definitely I believe BMD Bursa Malaysia Derivatives will consider launching a mini FKLI contract. Yeah.
Yep.
Then you can use that. Yeah. If not, there's no issue to hedge against your portfolio because your portfolio is just too small.
Too small for the hedge to work, right?
Yes. Yes.
So and another consideration is that when I think of like those high net worth investors, let's say they have multi-million. I think multi-million is not big, but maybe like in the tens, millions or 100 millions invested in the stocks, they cannot exit their position in a few days, right? It's very hard for them to do because when they keep selling one stock, the price will keep going down and then it will crash the stock, right?
Yes.
So they don't want to do that. And if they have this knowledge about how this hedging and futures works, they can definitely use some contracts, and it's a very good thing for them to use, right? Isn't it?
Definitely. That's why, as much as we think that when the foreign fund move out, they also suffer from the market crash. But the fact that as long as they use futures, and if they hedge more than their portfolio, why they want to hedge more than? Because if they are the major player in the market, they know that when they pull out from the market will crash. The price will crash on the stock. So technically, it's in their interest to make some money before they run. That means to them, not merely hedging. They can double up, triple, or 4 times, 10 times of the position in the short position against their cash. So that means when they pull out, they lost 10% in the cash. Maybe they can make 100% from the future position.
Wow, that's a very good example.
They can make a lot of money when market goes up and come down. They can over hedge, which could be one of their trading strategy. That means yes, they are using the hedging strategy, but technically because of they don't observe the hedge ratio, they are speculating. But the fact of they know that when they pull out, everyone pull out, the market will crash. They are in a better position to leverage on the so-called their own insider news to benefit the market. But individual, you and me, will not be able to do this because of we just do not have the influence in the market, unless you are a big funds manager. Yeah.
Nice. So, thanks for sharing, Warren. This is really good example you voice out here. So for those who can understand Mandarin, so we will have the same session done in Mandarin. If you learn Mandarin better, then next week you can check out our session here, back here, and then we will also have Warren in the next month. So he'll come and do a series of webinars regarding these subjects. So thank you everyone. Stay tuned for my email announcement of the next upcoming training. Once again, this webinar is an educational initiative brought to you by Bursa Malaysia Derivatives Berhad. Thanks, Warren. You have a nice day.
Thank you, Casey, and thanks for everyone for tuning in, and see you in the next session, either Mandarin or English. Thank you.
Goodbye.
Bye.